Any other organizers or panelists on the line. When you are ready to begin the presentation, press the Start Broadcast button on the GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon, everybody. Thank you all so much for joining us today. This is for our webinar on the Secure Act, Understanding the New Rules. And for those of you who are joining us for the first time, my name is Amanda Sylvia, and I'm the Client Service Associate for Stonehearth Capital Management. I've been with the firm for 5 years, and my role includes client service, marketing, and compliance. I'd like to just start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of them and will ask Jamie to answer as many as time allows. If we do run low on time and are unable to get to your question, Jamie or I will reach out to you directly at the conclusion of the webinar to make sure we do get your question answered. Now I would like to introduce our speaker for today. Jamie Upson is Stonehearth's President and CEO. Jamie has been with our firm since 2000, and in the first couple of years here, he focused mostly on portfolio management, design, strategy, and product analysis. In 2006, Jamie passed the CFP exam, and he spent the next 11 years at Stonehearth co-managing client portfolios and building, analyzing, and monitoring client financial plans. In 2017, Jamie purchased the firm and hopes to lead the firm forward and continues to help clients meet their financial goals. Jamie, thank you so much for joining us today.
Excellent. Thank you, Amanda. Amanda, my screen's not allowing me to share presentation, so I'm not sure if you're coded as the presenter. But if you either want to just pull up and share your screen with PowerPoint presentation or change it to me, I should be able to do that. So welcome, everyone. I appreciate you joining us today. If you're not in New England, you're probably going to fare better over the next couple of days. We do have a little bit of snow coming tomorrow, and I heard that the temperature is going to hit 0 very soon. So we got some cold air coming in. So if you're someplace warm, I'm jealous. So thank you again. I am going over the Secure Act, which is setting every community up for retirement enhancement. That's what they actually refer the Secure Act to. We're just checking to see why our presentation is not coming up. It was coming up actually a little bit ago and gave me the choice. So just bear with us just for a second. Well, I'll reference that there's a couple of 3 major areas that I'm going to discuss today. The first is personal and retirement impact, so the things that are going to impact a lot of our clients. The next major area that we're going to address is to go over new required minimum distribution rules. And then the third section is I'm going to dedicate towards business retirement plans. So while we're actually trying to get the slides up and running, which we can always send to everybody as well, I just want to start with some of the new required minimum distribution rules. For many of our clients, they may have already heard that the RMD, which is required minimum distribution, the age has since changed from age 70.5 to age 72. For anyone that was reached 70.5 by the end of 2019, you're going to be grandfathered into the old rules. For anybody that is now that was not 70.5 by the end of 2019, you're going to fall under the new rules, which means that you do not need to start your required minimum distribution until you reach age 72. So that's a nice little gift by the government for those that can afford not to take required minimum distributions. They get to delay their required minimum distribution now for 1 to 2 years. The reason that that's important and a nice benefit is because required minimum distributions are taxable. They're considered taxable income. So if you don't need the distribution, it's sort of like, well, why would you take it? Well, the IRS wants you to pay taxes on the distribution. So that's why they're they're forcing you to take the distribution. But now, if you can afford to delay for 1 or 2 years, then we should, then if you can afford to do it, then why not? That's a good play. The next thing that I want to talk about is life expectancy tables. Hopefully everybody can see my screen now. If not, just hopefully somebody can post something to let us know, but I think I got the thumbs up that it's up and running. So the next thing that I want to mention is life expectancy tables, which they updated about 10 years ago. We're still using the same table, so that has not changed. So that's good news. The next thing I want to go over is just an example of required minimum distributions. Here we've got Stephen and Sandra. Stephen is 70 years of age. Date of birth is June 30th, 1949. He turned 70 and a half in the same year that he turned 70 in the year 2019. So we're using the old rules for Stephen. Sandra gets a nice little bonus here. She's 70 as well, but her date of birth is 1 day after Stephen's, or July 1st. So she's going to turn 70 and a half in January of 2020. And so she falls under the new rules, and she doesn't need to start taking her required minimum distribution until the age of 72. So for her, based on her date of birth and when she turns 70 and a half, her required minimum distribution is not going to start until 2021. However, just remember that your actual required beginning date is really April 1st of the following year. So for her, she could take it as late as April 1st, 2022, but then she'd also need to take her normal distribution for the year 2022 and double up with 2 distributions, which is usually not advisable. So for Sandra, in most instances, we would still have Sandra take her 2021 distribution in that calendar year. For those that still have compensation and are still working, you are prior to the Secure Act, you were not allowed to contribute to an IRA account even once you reach the age of 70 and a half, even if you were still working. You could still participate in a 401k if that was available to you, if your employer had that and offered that, but you were no longer allowed to contribute to an IRA and get a deduction as well. So a lot of people were bummed out by that, and this new Secure Act, what that did is recognize that people are working longer, and they waived that rule or that limitation, and people who have compensation and are still working past the age of 70 and a half are allowed to make deductible IRA contributions. One point to make is that Roth IRAs always had this ability, because remember, when you make a contribution to a Roth, you're not given a deduction, so it didn't really cost the government or the IRS anything. So they always allowed people after the age of 70 and a half to make Roth IRA contributions. I do stress that if you're not working, these don't apply to you. You have to have compensation in order for this to work. Another thing that was passed a couple of years ago and made permanent, because for a while it was something that at the end of the year, it was a last-minute announcement by the government whether they were going to offer QCDs or not. QCDs stands for Qualified Charitable Donations. And what that means is if you make donations to a charity, a 501c3, then any required minimum distributions that you took from your IRA that you sent directly to the charity would not be treated as taxable income. And a lot of people think to themselves, well, that's not a big deal because I already had the ability to deduct any charitable contributions on my tax return under Schedule A, the itemized deductions. However, just remember that more recently, a couple of years ago, they changed the standard deduction up to about $24,000 to $25,000 now. And so a lot of people weren't actually making use of their itemized deductions. So if you made a $10,000 donation to a charity and you didn't have any other itemized deductions, well, your $24,000 or $25,000 standard deduction exceeded that. So you just ended up using the standard deduction and never really got any monetary benefit from the charitable donation. So QCDs became pretty popular, and just recognize that you can still do QCDs starting at 70 and a half. So we usually use about $1,000 as the threshold. So if you're making donations, you're over the age of 70 and a half and you have an IRA account, And one thing that you may want to consider doing is just contacting us, and we'll have TD Ameritrade just send the required minimum distribution of whatever amount you want directly to the charity, and that will be treated as non-taxable income. This way you actually do get a benefit. Now, one of the things that the Secure Act did pass was they said, hey, if you're over 70.5 and you are making deductible IRA contributions and you're also doing QCDs, we're going to offset any QCDs by any deductible IRA contributions that you've made. So, for example, let's pretend that I'm still working, I'm 70.5, and I'm going to work for the next 5 years, and I put in $5,000 per year into my IRA and took deductions. So at this point, I've got $25,000 worth of contributions that I've made to my IRA. And then at age 76, I want to make a $30,000 donation to my church. Well, I have to add up all of the deductible IRA contributions that I've made after age 70.5, in that case, 25,000, and subtract that first from the QCD amount. So in reality, I would not get, I would still have to pay taxes on the 25,000 that I sent to charities, but I would get a tax break and not have to pay taxes on the 5,000 in that example. So just recognize that if you plan on making IRA contributions after 70.5, and you're interested in QCDs or charitable gifts or donations that you plan to do from your IRA, just know that you have to track your IRA contributions that you've made only after 70.5. We saw a couple of changes in the 529 world, which are college savings plans. First, they expanded the list of qualified expenses. These now include apprenticeships. A couple of years ago, they also added to that list kindergarten through grade 12, where you could use $10,000, up to $10,000 per year towards those expenses. So one other nice benefit that they added was 529s can now be used to pay for student loans. However, just recognize that you can only do this one time up to a $10,000 limit. It is a lifetime limit. So, you know, nowadays with kids that have, you know, hundreds of thousands of dollars worth of student loans, obviously depends on where they went to school. This is a, you know, relatively minor impact, but it is nice to be able to use 529 assets if you still have some available that you, along with having some student debt. There's also a little bit of a planning opportunity there where if a grandparent has 529 plans for their grandson or granddaughter, one of the things that the granddaughter or grandson might want to do is take out a loan, and then once they're out of school, go ahead and then use the 529 asset that your grandparents had to pay off the loan. The reason to do this is for financial aid purposes. It increases the chance that you'll get some financial aid. One other point that I just want to make is, even though these have been passed, double check with your state, like Massachusetts or Vermont. If there's a state income tax, the states have been slow to adopt what the federal government has determined as qualified expenses. So we've actually seen some problems in Vermont where people have wanted to pay for private high school, and yet at the federal level, while we wouldn't have to pay taxes and a penalty at the federal level, the state of Vermont did not recognize that rule of K through 12. And so we would end up paying state income taxes on the withdrawal because they coded it as a non-qualified expense. So it's a little difficult because we're in the throes of it and the states are trying to catch up with the new rules. So just make sure that you're aware of it before, or ask us and we can research the individual states. Sticking with the theme of personal changes, medical expenses, they were scheduled to go up in 2020 to 10% of your income. So only medical expenses that exceeded 10% of your income, only those were considered deductible expenses. And one of the things that they did was they reduced that and kept it at 7.5%. It was scheduled to go to 10%. This is short-lived because starting in 2021, the number is going to go back up to 10% unless they change something once again. One other caveat that they added is if your non-reimbursed medical expenses exceed 7.5%, let's say my income is 100,000, the 7.5% is 7,500. Let's pretend that I had $15,000 worth of non-reimbursed medical expenses. Not only, one of the things that they allow for now is that you can actually take up to, in this scenario, in that example, $7,500 out of your retirement plan or IRA. You still have to pay taxes on it. It should be a deductible line item, but to help offset that, however, they're not going to charge the 10% penalty, which they traditionally charge if you're under the age of 59.5. So again, these are very technical things. We want to get these out to our clients so they can at least hear them. And if you have questions about them and want to go through the mechanics of it, then just get our attention and we'll go over it with you in more detail to see if it applies and how it applies for you. The kiddie tax. Kiddie tax is something that years ago, IRS implemented this so that if I have children and if I'm a gazillionaire and I pay a lot of taxes at my own level, then one of the things that wealthy families were doing is they were transferring assets or stocks to their kids because kids have a lower tax rate. And so what they did is the IRS passed something that said, hey, we'll let you do that for the first $2,100 of unearned, which is really like dividends, capital gains, things that come from portfolio. We'll let you have the first $2,100 at the student's or the child's rate, but then anything above that, we're going to just tax at the parent's rate. So that's what we've always called the kiddie tax. With the Tax Reform Act of 2017, they actually changed that so that anything above that $2,100 was actually taxed at the trust and estate tax level, which is really disadvantageous because you hit the maximum tax bracket of 37% when your income exceeds about $12,000 or $13,000. So they call this the run up the ladder of tax brackets. And needless to say, you had a lot of upset people that had children that had a lot of unearned income. So what they did, they got a lot of complaints, and so they reverted back to the parents' rate for unearned income that exceeds it might actually be $2,200, but it's in that $2,000 range. So they actually went back. This is effective immediately for 2019 tax filings, and they'll also let you amend your 2018 tax return. So I guess that's kind of like a whoops. I guess we passed something that we shouldn't have. The next thing is births and adoptions. For any new parents out there, you're allowed to take money out of your IRA account or 401k to the tune of up to $5,000 to cover qualified expenses there. Again, if you have non-retirement assets, it's better to use those than to take the money out of the IRA, but just recognize that it's your strapped for cash, which young parents can sometimes be. If you've got money in a retirement plan, that you can get some relief by taking some money out of the IRA. Now, important, it's still taxable. It's just not going to be subject to the penalty-free tax. I'm sorry, I said that wrong. It's still going to be taxable, but it's not going to be subject to the penalty of 10% when you take money out of an IRA account or 401k prior to 59.5. All right, let's go to the next section. All right, so now we're going to switch over to the new required minimum distribution laws regarding the stretch IRA provision. So a lot of the other things that we just went over were the government giving us some additional benefits. Here is where they go back and they take even more away from us. At the bottom of the screen, you'll actually see it's expected to raise about $16 billion in tax revenue by changing these new stretch IRA rules. So what does stretch IRA mean, first of all? Stretch IRA meant that if I passed away and I left my retirement account to my child, or somebody else, usually we're talking about non-spouses, maybe my sister, my brother, my aunt, my uncle. If I left money to them, then what they could do is turn around and keep it as in a tax-deferred state, meaning they don't have to pay taxes on that IRA yet, but they are going to have to take annual withdrawals based on their life expectancy. And so if the beneficiary of my IRA is young, well, they got to stretch that IRA out for a much longer period of time by only being forced to take small distributions each year. Remember, distributions is what triggers the tax. So the IRS said, man, that's a huge benefit that we're giving people, where we're allowing people to put money into their 401ks and IRAs. And this could go on for generations where we're not getting any tax revenue, or we're getting a very small amount of tax revenue. So they took away this nice little feature. Fortunately, they grandfathered people in. So what you have to pay attention to is if the account holder, meaning the IRA owner or the 401k owner, passed away prior to 2020, it doesn't matter if it was 10 years ago or a day before 2020, you get to continue to use the stretch IRA. So for those beneficiaries who inherited an IRA account, usually from a non-spouse, so if your parent passed away and you have an inherited IRA, you're taking, maybe $1,000 a year out of that account, you get to continue to do that, and you don't have to use the new accelerated schedule. The new accelerated schedule applies to any account owners that pass away after January 1st of 2020. They have a new 10-year rule, the 10-year requirement. And what that means is the IRA account or 401k needs to be withdrawn, which means taxes, by the end of the 10th year following the owner's death. As I mentioned, this is expected to raise about $16 billion in tax revenue. So this is going to be a big hit for a lot of beneficiaries. And it upsets a lot of IRA account owners because they had planned on their retirement plan creating like a pension for their children. Pensions have gone by the wayside for most corporations. And so this was a parent's opportunity to sort of replenish that concept of every year receiving some income. And this really has just accelerated the distribution so that now you have no more than 10 years to withdraw the entire IRA or 401k. And by the way, when I'm referring to IRAs and 401k, it really applies to all pre-tax retirement accounts, 403Bs, simple SEPs, 457 plans, 401k plans. So there's a lot of these kind of accounts. And the final note here, it even applies to Roth IRAs. And some people might observe, well, wait a minute, I thought Roth IRAs are tax-free accounts. Well, that's true, but the IRS doesn't want them to be tax-free forever. So what they do is they force you to withdraw that account. It doesn't trigger a tax, but you no longer get tax-deferred and tax-free growth of assets. So Roth IRAs are included in this new rule. So just want to stress those people that get to continue using the stretch, which is on the left-hand side, that's for any account owner who passed away prior to January 1st of 2020. They've been quote unquote grandfathered in. There are some for everybody after that passes away after January 1st of 2020, or I guess on January 1st of 2020 or after, they must use the new 10-year rule that we were just talking about. So who's exempt from having to use the new 10-year rule? Well, first of all, spouses don't have to use this. So if I pass away and my wife takes over my IRA, she does not need to use this new 10-year rule. And in fact, I'm going to show you on a slide, spouses actually have some other options that are available. If my spouse is already predeceased and I leave everything to my children, my kids are 12 and 15, well, they also are exempt from the 10-year rule for a little bit of time. The way that the law reads is that minor children are not subject to the new 10-year rule until they reach the age of majority, which depends upon the state, but it's usually age 18 or 21. I believe Massachusetts is age 18. So if I leave half of my retirement account to my 15-year-old, She's got 3 years where she just needs to use the old rules of taking a smaller amount out each year for those 3 years. And then once she reaches age 18, she does revert over to the new 10-year rule. That clock starts from age 18 to age 28. By age 28, she has to have the entire account liquidated. Now remember, this can trigger an immense amount of taxes. If you think, if my oldest were to inherit $1 million IRA, potentially 10 years worth of growth, it could be now a $2 million IRA. And if they close that out, imagine reporting $2 million of taxable distributions on your tax return. I promise you, you're gonna not be happy with that. The tax bracket at the federal level is 37%. Depending upon your state, here in Mass, it's about 5%. So you're gonna lose 42% of the account value just because of taxes. So this is a pretty substantial change, and one of the ways that they're going to make sure that they get their $16 billion in new revenue. Other people that are exempt: disabled or chronically ill beneficiaries, or the wording of this is kind of strange, but individuals, an individual who is less than 10 years younger than the account owner. So if I have a younger sister who's 8 years younger, and I leave the money to my IRA to her, she gets to keep using the old stretch rules, and she does not need to distribute the account in 10 years. We're going to go through a couple of examples because I appreciate this is not necessarily easy, especially when we're talking about laws and rules. So first, we've got Stephen here. He passes away in 2020, so that obviously triggers the 10-year, leaving an IRA to his wife, Tammy. So here again is the exception. A spouse is exempt, as we saw on the prior page. So spousal beneficiaries are exempt from the new 10-year rule. The 10-year rule you would normally think would apply because of this. Stephen passed away in the year 2020, but spouses are an exemption. So Stephen's spouse does not need to worry about the 10-year rule. She has two options. She can either move Stephen's IRA account into an inherited IRA and take annual distributions based on her life expectancy. We call that the stretch IRA. Or spouses, and only spouses have this option, Stephen's wife could actually just move his IRA directly into her IRA account. And then we just have to follow whatever her rules are when she passes away, or her required minimum distribution rules. Again, spouses are the only ones that can actually move an IRA that they inherit directly into their own IRA. Everybody else has to keep it as what's called an inherited IRA, so the IRS can track who needs to start taking required minimum distributions, who falls under the 10-year rule, et cetera, et cetera. Here we've got a 13-year-old, Ian, who inherited his father's IRA, and his father passed away under the old rules. So Ian is a non-spouse, Ian is a minor, and he must take annual lifetime distributions for the rest of his life. So this is pretty straightforward. Again, a minor child, his father passed away under the old rules. So basically, we're looking at a grandfathered scenario here. Next one, 13-year-old Ian inherits his father's IRA who passed away under the new rules. So Ian is a non-spouse. He is a minor. He must take annual lifetime distributions for the rest of, I'm sorry, I'm reading the wrong sheet. Ian is a non-spouse beneficiary. He is a minor. He must take annual lifetime distributions until he turns age of majority, which we talked about earlier, which in this example I say 18, and then he has 10 years to fully distribute the IRA account value. The next situation, 13-year-old Ian inherited his grandfather's IRA who passed away in 2020 under the new rules. So here's a trick one. Ian is a non-spouse beneficiary. He is a minor, but he still must distribute the entire inherited IRA by the 10th year after his grandfather's passing, since he is not the minor child of the account owner. If we go back to the exemptions, this one right here, minor children of the account owner. Since he received this from his grandfather, he is not the minor of the account owner. He is a minor, but he's the grandchild, and that doesn't qualify as an exemption. The area that's been rather complex for all of us trying to get our arms around is when trusts are the beneficiaries of retirement accounts. First, remember that if money stays in a trust and is not distributed, and really what we're talking about are irrevocable trusts, which is by default what happens when somebody passes away, the trust tax bracket reaches 37% when income exceeds or reaches $12,750. So in other words, trusts and estates do not have a very favorable tax structure. Even when the trust income is distributed to the trust beneficiary, beneficiaries can usually report the income on their own tax return, then thus reducing their tax liability. So let's just go through this example. So let's pretend that I leave money to my sister. My sister takes a distribution that actually goes first to a trust, because let's say that my sister was maybe, I don't know, maybe she had an addiction problem and I didn't want her to actually receive the money right away. So the money from my IRA gets pushed out to the trust, and then the trustee has a decision. Do they keep the money in the trust because they don't want my sister to receive the money? Maybe, again, she has an addiction problem or gambling problem, at which case, if we leave the money in the trust is going to have to pay taxes at a very high rate. The alternative is that we move the money from the IRA over to the trust, and the trustee decides to push that money that they received out to the beneficiary or my sister. Well, the good news from a tax point of view is normally my sister would end up picking up the tax liability, which is preferred over a trust paying the tax liability. However, that needs to be taken into consideration based on her gambling or addictive nature. So you just have to be careful and structure this properly. Usually, if you want one thing, you have to compromise on another. So if I want to leave money in the trust and delay access to that money for my sister, well, then the downside of that is it's going to be taxed at a higher rate. If I push the money out if the money is pushed directly out through the trust, we call that a conduit trust, then we get the benefit of having my sister pick up the tax liability. But, you know, again, it's all dependent upon how the people that created the trust, what was their game plan? Did they have minor children where they want to delay access to that money? Or do they have somebody that has substance abuse or a gambling problem, which is another common reason why you might not want to distribute the assets out to the individual, but keep it held in a trust. The downside is the taxes if you do that. So when you're dealing with trust as retirement accounts, there's now some hurdles that come along with this stuff. And let's go through an example of something that needs to be addressed. If you've got, here we got Ian again, he inherited his father's IRA who passed away under the new rules. He's a non-spouse, he's a minor who inherited an IRA from a parent. Lifetime inherited the IRA from, he didn't inherit it, oh, he did get it from his father. I'm sorry, I thought that was the grandfather. So he inherited it from his parent. We've got lifetime distributions until 18, and then a 10-year clock must begin. So the trust document tells the trustee not to distribute any of the trust to Ian until he's 30 years of age. But Ian inherited the IRA, and it must be liquidated and paid to his trust when Ian is still 28 years of age, resulting in the trust picking up the tax liability. This is going to be a surprise for a lot of people because this is a very common situation where people have established trusts and put in language in there so that the trustee does not distribute money to the minor or to that individual ultimate beneficiary until they reach a certain age. If that age is later than when that person has to close out the IRA, that in essence means that the trust is going to pick up the tax liability, and you're probably going to lose a minimum of 37% and sometimes a lot more depending upon state taxes. So again, down at the bottom it says, depending upon the values of the IRA and the state that the trust files taxes in, it's possible for the original IRA to lose about half of its value in taxes. And that is a very true statement and a very big concern for a lot of people. So just if you picked age 30 as to when they could get access to the money, you may want to revisit this and have it so that the trustee has a little bit more discretion as to when they distribute the assets. You know, if Ian's 22 years old and he's showing that he's very mature and handling his finances well, then they can go ahead and distribute that so you can push the taxes over to Ian as opposed to picking up the tax liability at the trust level. Okay, we're going to go to the final section. This has to do with business retirement plans. This is the final section that I'll address, having to do with the Secure Act. In essence, what they did was, one of the things that they passed was they allowed for retirement plan providers. So let's say that my company has a 401k plan. What they're allowing for is to have a pension option. Now, it's, to be clear, they've always had this option to offer a pension option. And what I mean by that, they call it an annuity, but just to keep things clean, what they're really referring to is if you purchase an annuity that generates a lifetime income stream. So I give it an insurance company or an annuity $1 million, and they promise to pay me, I don't know, $50,000 a year. That's what they're really referring to, which for many of us is a similar construct to a pension. So in the past, employers could do this with the 401ks, but what would happen if the insurance company went under that offered that annuity? It actually created a lot of liability risk for the company or the plan sponsor. So a lot of companies didn't want to include the annuity option because they didn't want to take on that risk. So what this new rule under the Secure Act did was it really holds the employer harmless there if the insurance company were to go under or have some financial hurdles that resulted in changes to the pension income stream. So they basically are now holding them harmless. So we expect to see that more employers are going to offer pension or what they'll call annuity options as a retirement benefit for people that have retirement plans. The next slide is focusing on small businesses, retirement plans for small businesses. Again, they're trying to promote savings for retirement for workers, and in particular small businesses. They've added a couple of perks here. They're designed to encourage retirement plans for small businesses. They increase the credit for businesses for establishing a plan. Under the new rules, you can now get up to $5,000 as opposed to what it was, $500. And this is good for 3 years. So you can get up to $5,000 for the next 3 years. They define small businesses as under 100 employees. So I don't know if we have an example. We do have an example here. So under this example, we got a new business called the Green Thumb Garden Center. The owner is considering a retirement plan. The owner decides to establish a 401k, pretty standard. The plan will cover herself and her 20 employees. Those have to be non-highly compensated employees. Those are the only ones that you get a payment for. The business can receive a credit. Again, the max is $5,000, but we created an example that maxed it out. You get $250 per non-highly compensated employee that participates in the plan. And again, you can get up to $5,000, and it's available for 3 years. And this one starts in the year 2020, which is now. Auto enrollment is the next area for small businesses. This has actually been something that we've seen a lot of success across the industry for businesses that when they have employees, they automatically enroll them towards saving in the company's 401k plan. So the employee actually has to do something about it, fill out a form if they don't want to have money automatically saved within the 401k plan. And so what they're doing here is for small businesses, they're offering a credit so that if you automatically enroll your employees to save a certain percentage of their income within the employer's 401k plan, there's a credit of $500 that can be added or that can be earned by the employer. And you get this credit for 3 years. And it doesn't even have to be a new plan. You just have to auto enroll. You have to start the auto enrollment and you can start that in 2020, and then get $500 credit each year for automatically enrolling. And if your employee, like I said, doesn't want to automatically save or doesn't like the amount that's automatically saved, they can increase it or reduce it from there. But the key is that they have to do something about it, and that's what the government tried to promote. Other section, we got a lot of part-time employees, and part-time employees were usually shut out of 401k plan at work. Traditionally, if you worked under 1,000 hours a year, you were not eligible to participate in the 401k plan. The Secure Act basically reduced that to 500 hours, so they're getting more people that can participate in the 401k plan. However, this is kind of a little strange. You have to show 3 consecutive years of 500 at a minimum of 500 hours per year, and the clock starts in the year 2021. So even if somebody's been working 500 hours over the last 3 years, that doesn't mean they automatically get to be eligible for the 401k plan today. What it does mean is that they start the clock in the year 2021. So this means that a part-time worker would not, the earliest they would be eligible is the year 2024. Kind of a little strange they did that, but those are the rules. And another one that's really hasn't gotten a lot of press prior to the Secure Act, and even after the Secure Act, this one doesn't have a lot of literature on it. We've always had this thing called the multiple employer plans, or MEPS for short. What that really meant is because of the benefits of economies of scale that usually happen, just think of Costco or BJ's or Sam's Club, when you buy things in bulk, you usually get greater discounts. Most employers offer their own 401k plan. Well, why not partner up with a whole bunch of other employers to get the economies of scale so that you get more money into a plan? So let's say that ExxonMobil or Cisco has a great 401k plan. Maybe I want to join that because rather than create my own, they already have one that's established, and I'd like to participate in that. Well, the challenge has been liability. Cisco would look at us and say, well, wait a minute, you're much smaller. I don't know that I really want you in the plan. If you screw up, you ruin it for all of us if you don't follow all the requirements, because 401k plans have a lot of requirements. So what the Secure Act recognized, they recognized this hurdle for many corporations, that they didn't want to take on that liability of other people or companies that participate in the plan. And so what they did is they are now actually holding them harmless from the actions of another company. So if my company joined the Cisco plan and my company was not following the rules, now only the company that's not following those rules is going to be penalized, and Cisco would preserve their good status under the 401k rules. So this is something that I think in theory it makes a lot of sense, and I think you'll see these grow in popularity because if the drive is to create scale so you can negotiate lower fees, then that should work. We'll see if it actually does. The first time that this is available is in the year 2021. So again, not a popular word right now, but I do expect in the business community that there will be a growing number of firms that are looking to create partnerships to leverage the economies of scale to participate in a 401k plan. That's actually it for my prepared remarks on the Secure Act. Again, a lot of rules in there. We've received already a handful of questions. I've been traveling to a lot of the TD Ameritrade branches and trying to help people understand these new rules. And some people are right on top of it. Other people aren't even familiar with the fact that they've changed the required minimum distribution to age 72. So full spectrum there. It's going to take time to infiltrate and to get everybody on the same page. So if you have questions about anything that I went over or any other areas that I didn't, because my goal was not to discuss everything pertaining to the Secure Act, but only those more relevant ones for our clients. I'm going to open it up now to questions if anybody has any.
Hi, Jamie. Thank you so much for all of that. We do have a couple questions. We did get a couple requests to get some of these slides sent out over to you. So I will go ahead and upload those on our website at the conclusion of the webinar so that you're able to access those if you do want them. And I will forward them directly to the people who did ask for them, so you can watch for that email. So Jamie, the first question I have here is, if I inherit an IRA from my father and I need to close it out in 10 years, do I need to take withdrawals each year, or do I take a lump sum in the 10th year? If that makes sense.
Yeah, good question. So you actually you're not forced to just take it in the 10th year. You're not forced to take it, 1/10 over 10 years. You're actually given full discretion to do what you want. The IRS, all they care about is that you close the inherited account or inherited retirement account by the 10th year. So really what this does is give you some planning opportunities depending upon when you think your taxable income is going to be lower. So if I'm 60 years of age, my father passes away and I inherit his $1 million IRA, and I plan to work for the next 5 years, I'm probably not going to take any distributions because it would only add to my taxable income. I would more than likely wait until I retire and then spread out the tax liability at that point.
The next question we have is, what solutions or considerations should be addressed now that the stretch IRA is dead?
Yeah, that's a good question, and all the strategists are trying to put together papers trying to identify how we optimize these scenarios. There are a couple things that you can do. I mean, first and foremost, sort of obvious, take a look at who you're leaving the account to. So if you have the option to leave the retirement account, to an exempt person, then you really don't have to worry about the 10-year rule. So that isn't always practical. If I'm married and I have kids and I just want everything to flow to my kids, maybe it's beneficial while they're minors, but then obviously that 10-year clock kicks in at some point. But common scenarios that I see is if I don't have children and I'm going to leave money to siblings and nieces and nephews, which you may want to consider doing if siblings are within 10 years younger than you. So say they're 5 years younger than you, then they're exempt. And so I might leave the retirement account to them and leave the non-retirement assets to the nieces and nephews who would otherwise be subject to the 10-year rule, at least when they reach age of majority. I actually was reading a paper from an estate attorney yesterday, and they were making a case for buying life insurance. So if you know that your beneficiaries are going to be subject to the 10-year rule, they're not even close to retiring yet, and so they're going to end up paying a lot in taxes over that 10 years that they have to distribute the assets, then you might want to consider purchasing a life insurance. If you're healthy enough to qualify for a life insurance policy, then take out a life insurance policy. So if I think my $1 million IRA today is going to grow to maybe $2 million by the time I think I'm going to pass away, and you want to look at this at an after-tax basis, a $2 million IRA after taxes is probably worth, maybe 1.5. I might go out and buy a $1.5 million permanent life insurance policy that I would leave to my kids to split, or the more insurance you buy, that's great, but it is going to cost more. But that's a great, what they call wealth replacement tool. I've always been a little negative towards life insurance because I usually view it as an income replacement tool for people while they're accumulating assets. And once they're retired, usually you don't need life insurance, with a couple of exceptions. But here's one of those where, yeah, if you know that whoever's going to inherit your account is going to be subject to the 10-year rule, you may want to start using your IRA now to buy a life insurance and pay for it, because life insurance is tax-free when they receive it. The only other thing that I can think of, I think it's the timing, which I guess I referenced this earlier. Just pay close attention to the timing of when you're going to, when your kids, this is after the fact. So if you didn't do anything and your beneficiaries are subject to the 10-year rule, then one of the things that they could do is just time the distributions properly. One other idea that I read about yesterday was, depending upon the beneficiary's tax situation, they might even consider converting the IRA to a Roth right away, and then getting up to 10 years worth of tax-free growth. And I can see in some scenarios where that does make a lot of sense. But these are really customized things that need to be reviewed carefully, because the ramifications are huge.
Jamie, just in the essence of time, we're getting to almost the 60-minute mark here. I'm just going to take one more question. It says, we named our trust as the beneficiary of our retirement accounts. What, if anything, should we do now?
Yeah, that's a good question. I mean, the correct answer is to meet with somebody to go over it. You know, the first thought is to schedule an appointment with the estate attorney who drafted the trust to see if that's still relevant. We could also go over that trust with you, and what we do is we just pretend that you pass away and see how it plays out, and see if that's still acceptable to you. If it's not, then we want to consider making adjustments to the trust. Or in some instances, maybe you don't use the trust any longer. But again, there's pros and cons to each one of these decisions, so it needs to be thought about carefully. I think you said that's the end of this presentation, or the end of the questions. If anybody has anything else or any other questions, feel free to email us or call us. I want to thank everybody for participating or being here today to learn more about the Setting Every Community Up for Retirement Enhancement, otherwise known as the SECURE Act. Again, any questions, please let us know, and we will put a copy of the slides on our website shortly. Thanks again for joining us.
Thank you. Have a great day.